capital stack in these types of deals. And this could be expected with other properties as well. So it's not just with apartments, but it's a good way to understand the basics of how capital can fall in line, and it's referred to as a capital stack. So let's say, trying to make sure my head's not cut off there. So let's say you've got a property that's we'll just say a $10 million purchase. Okay. What you're going to have, and your lenders can provide this, and you can work it out yourself. So what you're going to have is some sort of a capital stack. Again, I'm just going to show a very basic form of this. So in a typical loan, I mean, nowadays you're looking at probably around 60% loan to value, but average, when the market's not fluctuating so much, you could probably expect 70 to 80% of this 10 million being financed from a bank. So that's what this is over here. We'll say 70%. Oh geez, I'm writing upside down, getting all confused here. 70%, and we'll refer to this as your senior debt. They are the ones that in a $10 million purchase, they are putting up $7 million of that deal. Now, this other 30% up here, this is your private equity. So other operators such as myself, this is where we spend time going out and meeting with investors. People that are tired of investing in the stock market. They want to put their capital into a tangible asset. We talk to them, we educate them about the benefits of real estate and specifically apartments. And they come in and they acquire 30% of that private equity. Now, some of that is going to come from the general partners as well. A good chunk of that's going to come from the limited partners. So what you have here is, if we were to break this portion down a little bit further, you might see in some instances, we'll just say 80% of this 30% is your LPs, or those are your private investors. And then this other 20% is your GPs, or the ownership team. So that's an example of how this 30% of the private equity might be split up as far as ownership and returns go. So that's about all I wanted to get into this morning, with showing you how private equity and senior debt works together in these types of deals, because we have other webinars where we jump further into the splits between GPs, LPs. We disclose and talk about all the potential fees that you might see, and the reason for those fees. So yeah, simple capital stack. Again, you got your senior debt, got your private equity. Private equity might be split up in various ways. And so that would work out to be here $3 million that the operators would go out and raise from private investors. So for the remaining of our webinar, this hour, for the next 20, 30 minutes or so, Alex is going to dive in and talking about the senior debt aspect. And especially now with interest rates fluctuating and rising and dropping, he's going to dive in, let us know a little bit where the market currently is, where the capital market currently is, and some ideas and ways and strategies as an investor, both on the operation side and as a passive investor, things to look out for when vetting these types of deals in today's market, so that you can continue making educated decisions moving forward. So without further ado, Alex, I'll turn the time over to you. So why don't you go ahead and give us a brief little introduction about yourself, and we'll jump into it.
Sounds good. And yeah, Dallin, thanks for having me. Excited to be here. Definitely interesting times in the capital markets. In many ways, the market has never been more volatile. And as Dallin was referring to, and as you can see in the in the picture behind him, debt is really the most important piece of the capital stack. Traditionally, it's been the biggest piece of the capital stack. In today's market environment, it's not always going to be the biggest piece. Some of these deals only underwrite to 40-45% LTV, and so equity, whether it's common equity or pref equity or mezz debt, has to bridge the gap. But traditionally, in a normalized market, debt is definitely the biggest piece of the capital stack. You can theoretically get up to 80% of the property leveraged with agency and sometimes bank. And so choosing the right debt strategy is critical to achieving the targeted returns to your general partners and your limited partners as the investors. Ultimately, the best loan product is going to depend on the projected hold period, future interest rate expectations, and the business plan of the sponsors. And so I will touch on the market towards the end of this, where we're at, how the Federal Reserve is behaving, as they're the ones that set monetary policy and ultimately interest rates. But kind of want to take you guys through the different types of debt that exist for multifamily acquisitions. And so what we'll talk about primarily is perm debt. We'll talk about bridge debt. I'll touch on seller carry financing, which is becoming more relevant in today's market. But I'm going to go ahead and kick it off with perm debt. And there's really 5 different types of permanent debt. I'm only going to discuss 4 of them simply because CMBS lending in today's market, and really for the past 2 to 3 years, has not been that competitive with multifamily acquisitions. And that's really a very highly structured, complex, expensive on the front end, at least, loan mechanism. And it's really used for much bigger deals, and it's primarily used for commercial deals, not as much multifamily. So we're going to focus on agency, bank, credit unions, and life companies. And I'm going to go ahead and talk about agency financing first. There are 3 primary agency lenders in the United States for multifamily. There's Freddie Mac, there's Fannie Mae, and there's FHA. And actually, but before I go into all this, since this is a small group of people, and I think we can keep this pretty informal, if you guys have any questions at all while I'm talking, rather than waiting until the end, unless that's what you prefer, go ahead and just interrupt me, and I can answer any questions as they come up. So going back to the agency lenders, we're going to focus on Freddie Mac and Fannie Mae. I can talk about FHA if you guys want to, but similar situation with CMBS, not competitive at all. They're very good for like large ground up construction deals, but for most of the deals you guys are looking at, which I'm assuming are going to fall into the small balance or middle market realm, let's go ahead and keep it to Freddie Mac and Fannie Mae. So those are the 2 agency lenders I'm going to talk about. Within both agencies, there's small balance loans and then there's conventional loans. We're going to go ahead and talk about small balance first. And we'll talk about Freddie Mac small balance and then compare it to the Fannie Mae program. So a small balance loan for Freddie Mac is going to be loan proceeds between $1 and $7.5 million. Anything less than $1 million, they cannot securitize, and they won't do, bottom line. Anything over 7.5 million with Freddie is going to fall into their conventional bucket, and I'll touch on that program after we discuss small balance. The Fannie Mae cutoff is going to be $1 to $6 million. Anything over 6 is going to fall into the Fannie conventional bucket. So those are really the delineations on the loan dollars of what makes it SBL versus conventional. And the primary differences between Freddie SBL and Fannie Mae small balance, I guess the biggest difference is with Freddie Mac, you can rate lock at application, whereas with Fannie Mae, it's a different pricing mechanism. They directly index to the 10-year treasury, which moves around on a daily basis, and you cannot lock that treasury index. And so for that reason, Fannie Mae is a floating rate transaction until you rate lock right before you close. You cannot rate lock a Fannie Mae small balance loan until we receive all due diligence, third-party reports, borrower DD, org structure, org docs, et cetera. And so for 30 to 40 calendar days, if you're doing a Fannie Mae small balance loan, you are subject to interest rate volatility. However, that being said, as of today, Fannie Mae is about 100 basis points inside Freddie Mac. Freddie Mac SBL is really out of the market and has been for quite some time over the last like 3 months. There's numerous reasons for that, but bottom line is if you're looking at any deals today on, in that 1 to 6, $1 to $7.5 million range, Fannie Mae is going to be the best option.
Alex, real quick on that note, and as investors, you need to know this stuff. You need to ask your operators what type of loan product are they going after, and because that reason right there is huge. Are they locking in the rate at time of application, or are they locking it in 45 days from the time you first heard about the deal? Look how quick interest rates changed over the last few months. So if it's a floating rate and it's not being locked in for another 45 days, assuming the deal and inspection and everything goes smoothly, if there's some extensions that need to be filed, now you're looking 60 days. Now you're looking 2 months into the project. What are those interest rates going to do? So asking those questions up front as an investor is critical so that you can have a better idea of where things are going to be before you fund your capital, before you send over your investment. So I appreciate you bringing that up, Alex.
Yep. Yeah, and it may be that Fannie is not the best financing mechanism. It might be Freddie Mac, or vice versa. Like we had a Freddie SBL deal we were about to submit to Freddie Mac last week at a 6.5% interest rate for a 10-year fixed. This is a borrower that, long-term hold. She's never going to sell the asset. So we set her up with a 10-year fixed yield maintenance prepay, and I'll get into a little bit more about prepays later. But treasuries came down 60 basis points, actually almost 70 basis points since we apped the Freddie deal. And so we repriced it with Fannie Mae at a 350 treasury with a 190 spread. And I'm sorry, actually the spread was 150. So she's well inside of Freddie. And so we just switched the app over to Fannie Mae. So just an example of comparing the two loan programs. Sometimes one is significantly more competitive than the other, and vice versa. It really just depends on the appetite at any given time that agency lender has. I do suspect Freddie Mac is going to drop pricing in the next month. We're about to turn over the calendar into 2023. They just got their updated small balance allocations yesterday, which are significantly more positive than they have been in previous years. And so we calculated it. They're going to have to sign up about $125 million worth of business every single week to hit the cap that their regulator, the FHFA, mandates that they hit. Like they have to put this money out. And the only way to do it is to drop pricing. They're not going to be able to originate loans at 6.5% when the rest of the market, at least their direct competitor Fannie Mae, is in the mid fives. So more to come on that, but I do suspect Freddie Mac SBL pricing is going to come down significantly in the next month, which is good news. So that's really the primary difference between Freddie Mac and Fannie Mae small balances is the upfront rate hold with Freddie. Both are fixed rate loan programs. They both offer 5, 7, 10-year fixed rates. They are typically more competitive on the longer end of the curve. So their 10-year fixed rates are more competitive than their 5-year terms. They like to be on the longer end of the curve. And the reason for that, especially right now, because the yield curve is inverted, you're typically going to end up with a better interest rate on the longer end. Fannie Mae small balance will go beyond 10 years. They'll do 12, 15, 20, 30-year fixed rates. Freddie Mac, the longest they're going to do is a 10-year fixed rate. Both programs are coming with 30-year amortizations. You can get, partial or full term interest only. They're non-recourse. There's a lot of bells and whistles of these programs, but they're highly nuanced. They're very programmatic. And that's why you would want to engage someone like CBRE, who does more of the Freddie Mac SBL than anyone else in the country to underwrite these deals and originate directly the small balance loan. So I think I'll leave it there for the small balance loans. I've got handouts on both of these programs I can circulate after the call if anyone wants them. They're really good reference guides. But ultimately, if you guys are looking at deals and it falls into the small balance bucket, engage us. We're happy to underwrite deals, look at deals for you guys, and let you know whether it's better for Fannie or Freddie. Moving on to Freddie and Fannie conventional, same agencies, just different products. Typically, these are going to be for middle market or large institutional size deals, all the way up to $100, $200 million. But again, the cutoff is $6 million for Fannie and 7.5 for Freddie. Anything over that's going to go to the conventional product. They also offer fixed rate products, 5, 7, 10 years. They're definitely more competitive on just like SBL, they're more competitive on the longer end of the curve. These are both Freddie and Fannie you can do a streamlined early rate lock, but for all intents and purposes, unless you're like a select sponsor for Freddie and Fannie, you're basically floating until you close. And these loans are both priced with spreads over the corresponding treasury index. So, you're in a 10-year fixed at 200 basis points over the 10-year. And that's going to be the same for both deals. They do both offer floating rate options, which can be beneficial depending on your hold, your time horizon and your strategy. And there's pros and cons to this, but basically you could get a floating rate conventional agency loan at 220 basis points over 30-day average SOFR. 30-day average SOFR, I think, is around 3.8. For context, SOFR was at 5 basis points about a year ago, so basically zero, and now it's almost up to 4%. So there was a lot of floating rate, both floating rate bridge and floating rate agency lending going on in our market over the last couple of years, simply because sponsors could get, 2 handles, 3.5% coupon rates on their floating loans with not much risk at the time of the rate going up. I'll get into more about floating rate debt when we talk about bridge, but just know that it is an option for conventional Freddie Mac and Fannie Mae loans. I think I'll stop real quick and see if anyone has questions.
One question in the chat, Alex, was if you could attach those links into the chat box.
Yeah, when I'm done talking, I can upload the PDF handouts. I'm assuming that's what they're asking for.
Yes, and if you want to send those over to me as well, I can attach those to our follow-up email that goes out to our network.
Okay, great.
So
moving on, I'll just kind of hit the highlights on what the pros of doing agency loans are. They're automatically non-recourse. You're never talking about partial or full recourse. They're always going to be non-recourse loans. What the sponsors will do is execute what's called a bad boy carve out. And so it's non-recourse as long as you're not doing something stupid, like committing fraud or making material misrepresentations to the lender, things of that sort. That's when personal recourse would get invoked, but otherwise they're non-recourse loans. As I said earlier, you can theoretically borrow up to 80% of the property's value. I have not seen that personally for at least a year and a half. You could do that in Phoenix when cap rates were north of 6%. But with where the cap rate environment is today, granted, they are decompressing. So we're starting to see LTVs kick up, even though interest rates have gone up. But I think, Dallin, you said earlier, Average LTVs now is around 60, 65. It was down to 50, 55% like 2 months ago, but now that cap rates have decompressed by around 50 basis points, in some cases even more than that, we're getting back up to the low 60s on perm leverage. Not every deal, of course, but if it has a 5 in front of the cap rate, we're typically getting close to 60% now. And it's trending upwards. I do expect cap rates to decompress another 50 basis points. But we'll see how that plays out here at the beginning of 2023. Another benefit of agency loans is the availability of interest only. As I said earlier, you can get 1, 2, 3 years of IO, even full term interest only, 10-year fixed, 10 years of IO at lower leverage, higher debt covers. Agency offers for longer fixed rate terms than what you can get from banks or credit unions. Banks and credit unions want to stay on the shorter end of the curve because most of them are balance sheet lenders and they don't want to take on the interest rate risk of originating a 10-year fixed rate. They'll do it, but they're going to be compensated for it. So if you're looking at a 10-year fixed, really 7 or 10-year fixed, agency is always going to be more competitive at that end of the curve than any other lender. Another benefit is that agency loans are assumable to a new buyer. Not a lot of the deals, I don't want to say a lot because there's not a lot of deals happening in Phoenix right now, but the deals that are getting done either have assumable agency financing on them, at like 3.5%, which unlocks all types of intrinsic value to the investor, or there's seller carries, or there's still some cash 1031 buyers out there. But the vast majority of deals getting done in the market right now have assumable loans on them. And that is a huge benefit to agency loans. They also offer supplemental financing, with the exception of Freddie Mac small balance. They're the only agency lender that does not offer supplementals. And what a supplemental loan allows you to do is, say a year from now, you've increased the NOI through meaningful rent growth, or you've gone through the property, did your CapEx plan, raised rents, increased the NOI enough to support at least a $1 million loan. You can come to Freddie or Fannie and get cash out of $1 million or more based on the increase in that NOI. And then the supplemental loan is just a second, and it's coterminous with the first mortgage. So that's a great benefit with Freddie and Fannie with all of their products except for Freddie Mac SPL. Another benefit is the national coverage aspect. Agency will go into any state, any market, secondary, tertiary markets, which is huge. If you're trying to syndicate a deal in some tertiary market in Louisiana where there's no or very limited bank competition, agency is going to be the only game in town. And it's a real benefit to be able to use Freddie or Fannie in secondary and tertiary markets. Another benefit is that there's no tax returns or K1s like you have with a bank. Even if a bank is doing non-recourse loans, they always want tax returns and K1s of the guarantors. And there's a lot more hurdles you have to go through on a personal level with a bank or a credit union than you do with agency. With agency, as long as you meet the net worth and liquidity requirements and your credit history is good, it's all about the property at that point and your org structure. But if you clear those 3 hurdles with agency, you don't have to mess around with all of the other, tax returns and K1s and all the other personal stuff that other lenders are going to require. And then the last benefit I would like to highlight is the agencies are really here and have a directive from the regulator, the FHFA, to provide liquidity to the market in times of volatility, which is exactly what we're in right now. Freddie and Fannie are always lending money. Always. They're always in the market. They're never out of the market. Whereas a lot of other lenders will move to the sidelines in times of volatility, such as banks or life companies. And life companies for a different reason. I'll get to that in a minute. But Freddie and Fannie, always in the market. The cons of agency are they've got pretty rigid multifamily experience guidelines. They typically want the GPs to have at least 2 years of previous multifamily experience. There's exceptions to that that we can get, just depends on the story. but they typically have more rigid multifamily experience requirements than other lenders do. The loan docs are non-negotiable, whereas with other lenders, you can negotiate terms and reporting requirements, et cetera. The attorney fees for conventional agency loans can get pretty expensive. We're talking 15 to 20 grand, potentially more, depending on how complicated the org structure is. On the small balance end, the attorney fees are like $6,000 to $7,000, but on the bigger deals, are going to be around $20,000. And then the last one I want you guys to be mindful of, because I'm assuming I'm talking to private capital and like small syndicators here. The agencies have recently mandated that the sponsors, the lead syndicators are contributing at least 5% of the total equity. What a lot of syndicators in our market were doing up until like last year was they were putting in a minimal amount of equity, like 1% to 2%. And some of them were even rolling their acquisition fees in as the equity into the deal. Agencies have caught on to this. They're not allowing it anymore. They want 5% fresh GP equity into the deal. So that is the extent of, I could talk about agencies all day long. I think that's probably good for now. I'm going to talk about banks and credit unions next. Are there any questions about agencies?
Yeah, there's a couple questions in the chat box, but real quick on that last note that Alex made here. Let me come back to my chart. So in this example, we talked about this $3 million in this $10 million example. This $3 million is going to be the private equity raise. So what Alex is saying is a lot of these agencies now, agency debt providers are saying, okay, you need to raise $3 million. The GPs, the general partners, have to put in 5% of that. So 5% of the 3 million is 150,000. Now, this is not a bad thing as an operator or as a limited partner, as a passive investor, because as a passive investor, the more money your operators are putting into the deal, wouldn't that make you feel a little bit more comfortable that they have a little bit more skin in the game? But what was happening is in most deals like this, you'll see like a minimum investment for a type of deal like this at $50,000. So what some operators were doing was coming in and just saying, hey, we got skin in the game, but we're just putting in the minimum while they're raising capital from other investors, which different people have different opinions on this, right? But when the lenders found out what was going on, or they were rolling some of their acquisition fee, they said, no, we want 5% of that 3 million of the general partners in that deal. And so just to give you a visual of what that looks like. So, and then in the chat box, Alex, a couple questions here. First one is, does agency have a cutoff for the year built? And will they fund a 100-year-old building?
I've seen them fund, at least on the small balance side, 1920s vintage. So there you go. Yeah, there's not like a cutoff on vintage. So here's what they do. They're going to obviously get an appraisal, and they're going to get a property condition report. And as long as there's not significant deferred maintenance, regardless of the vintage, they'll do it. If there is significant deferred maintenance, especially life safety items, they'll either make the borrower fix it prior to closing, or I guess in this case, it'd be the seller fixing it prior to closing, or they'll give you 90 days after you close a loan to remedy the issue, or sometimes up to 12 months. It just depends on the severity of the deferred maintenance.
And what if there's still knob and tube wire? It's a follow-up question.
I don't know what that means. Are you talking about Zinsco, or are you talking about it like yeah, I think it's referred to as Zinsco.
Yeah, hey, this is Chris just jumping in. We got a building we're looking at, and it's built in 1925. It's a 17 unit, and it's old, but it still has knob and tube wiring throughout it. 2-wire, so it's not grounded wire.
Got it. So that's where we would allow the engineer that's completing the property condition report to opine on whether that's life or safety. I have seen in Phoenix, like if it's Zinsco, and there's Stablock and Zinsco.
Stablock.
If it's one of those panels, there are very few insurers that are going to do that. There is like one or two carriers out there that'll provide a temporary policy allowing the sponsor to get it converted, and then you can get a permanent insurance policy on it. The agencies have been okay with that. They just make it a post-closing condition. So the short answer is it needs to get remedied. And they'll typically give you, I think it's like 90 days after closing, it has to get replaced.
Cool, thanks.
And Alex, a follow-up question to that as well. So from a lender point of view, if there was this older property that operators found and investors wanted to get in on, and some of this stuff, there was the severe deferred maintenance or some of these life and safety issues, would you suggest that they go in with a hard money loan or a bridge loan to get the work done and then refi into a fixed agency loan?
Depends. Depends on how significant it is. Depends on the current NOI of the property and what loan amount it supports. It depends on the in-place cap rate. I mean, if you're buying it at a 7 cap, you might be able to get somewhere close to 80% LTV. And then you don't really, there's not much of a need for a bridge loan at that point. But if it's a 5 cap and you can only get 55 or 60% perm debt, yeah, it might be better to get a 70% bridge loan and have the CapEx financed and then exit out into agency once the CapEx is completed and the property stabilized.
Awesome. Thanks for sharing. And then there was another question here. Can you repeat the small balance and conventional loan dollar limits for Fannie Mae?
Fannie Mae is $1 to $6 million for small balance. Anything over 6 million is going to fall into the conventional bucket.
And how do the rates vary on those two loans?
Right now, between Fannie small and Fannie conventional,
Correct.
they're pretty in line right now. The spreads are, it depends on a variety of factors, like if there's affordability in the rents, like what LTV, debt coverage you're at, et cetera. So Fannie prices their loans based on tiers. And so if you're in tier 2, which is going to be anything over 65% leverage, and a 125 to a 135 debt cover, you're going to get a worse spread than you would if you're in tier 3, which is 55 LTV to 65 LTV and a 135 to 155 debt cover. And then if you're in tier 4, which is 155 debt cover or higher and south of 55% leverage, you're going to get the tightest spread. And that's going to be the same on both sides, whether it's small balance or conventional. So long-winded way of saying the pricing right now with Fannie between small balance and conventional is essentially the same.
Excellent. And I think that's all we got for questions in the chat box. So if there's nothing else regarding this topic, then Alex, we'll let you move on forward.
Okay, great. These next 3 lenders I'm going to move through more quickly than agency. So let's talk about banks. Banks can be very good financing providers. And they have been for a number of years in Phoenix. At any given time in the small balance middle market space, there's 4 or 5, maybe even 6 aggressive regional banks. And we know who they are at any given point in time. Appetites change on a monthly basis. But at any given point in time, there's typically 4 to 6 regional banks that have a strong appetite for multifamily. There's also community banks, which are going to be smaller, and those are banks that only have a presence in that specific market, call it Tucson or Phoenix or even like Flagstaff. Whereas regional banks are going to play in multiple markets, multiple states, and you can get pretty good competition between the banks. And there's going to be pros and cons to banks, just like you have with agencies. A lot of the banks are balance sheet lenders, meaning they're using their deposits to lend money out. That's how they make money, right? The net interest margin they get. Some banks will securitize and sell off on the secondary market. Much larger banks do that. But for the vast majority of the deals you guys are going to be looking at, it would be, they're probably going to be a fit for a community or a regional bank. And because they're balance sheet lenders, They're very cognizant of interest rate risk on the longer end of the curve, which I mentioned earlier. So banks are really set up for shorter term fixed rates. Almost every bank is going to offer a 5-year fixed with another 5-year fixed behind it. The rate's going to reset for the second 5 years. Or sometimes they'll even do a 3-year fix and then another 3-year fix. And there's a lot of structuring that goes into it, but bottom line, banks are going to be competitive with 3 and 5-year fixed money, sometimes 7, but they're really set up for 5-year fixed rates. They all come with step down prepayment penalties, which I actually failed to mention this with agencies. Agencies are set up with yield maintenance, which is a whole nother discussion. The bottom line with yield maintenance is you would really only want to take that if you were planning on holding the loan for most of the fixed rate term. Otherwise, yield maintenance can become very, very expensive. If interest rates if they go down when you prepay it, you could be paying Freddie or Fannie upwards of 20% as a prepayment penalty. So message me directly if you guys want to have a conversation about yield maintenance. That's a separate topic. There are step down prepayment penalties available with agency for a pricing adder, and they're not too bad on the small balance side, but on the conventional size loans, they can get pretty expensive.
And Alex, real quick on the yield maintenance, this is, you mentioned the assumable loans earlier on in a conversation. Is this why we're seeing a lot of these assumable loans occurring at this point? So people don't get hit with that major, that exactly. Large yield maintenance.
That's one of the reasons, right? The other primary reason is it helps someone sell their property when the buyer can get a 3.5% fixed rate for another 7 years versus trying to put new debt on it at 6%. But you're right. There's a lot of sellers that have huge bullets on their yield maintenance or defeasance prepayments, and that's one of the attractive qualities of agency is the assumable nature of the loan.
And are those typically written to where those loans can be assumed, or do you need to make sure that's in the contract when you originate that loan from the beginning?
It's in the contract. I don't know
Excellent.
if that answered your question, Dallin.
Yeah. Yep.
Okay. So yeah, moving back to banks, they all come with step down prepay. A 5-year fix could be 5, 4, 3, 2, 1, or 3, 3, 2, 2, 1. That's 3%, 3. And then it steps down to 2% for 2 years and then 1%. Some banks will do 1% flat prepay. These are things we can negotiate with banks. Oftentimes we'll get a deal. We're going to shop it around. We'll pit all the lenders against each other. And say, look, this bank is doing a softer prepay for X rate. Can you guys match it? So there's a lot of negotiating that goes into that kind of stuff. Another thing to be cognizant of with banks is that they typically prefer recourse. They will do partial or non-recourse at lower leverages. It was very commonplace for banks to be doing non-recourse under 65 LTV until recently. Now with the volatility and deterioration of the capital markets, a lot of banks they've tightened up their underwriting guidelines, and they are now wanting some level of recourse at any LTV. Doesn't matter what it is, because the guarantee from the sponsors is the secondary source of repayment. And banks are typically more conservative than agencies are, and that's why they're starting to offer or not offer, mandate recourse at any LTV. Banks are more focused on sponsorship underwriting than agencies are. Like I said, banks are going to require tax returns, K1s, bank statements. I mean, anything and everything if they want when it comes to you as a personal guarantor. And what they're going to do is they're going to do a combined cash flow analysis, whereas agencies just looking at a property level debt coverage ratio and LTV. A bank is going to look at both the property and then all your personal debts, your personal obligations, and they're going to combine everything. They're going to combine your personal income with the property level income, the property debt with your personal debt, and they're going to make sure you can cover everything if you needed to on a combined level. So there's a lot more hoops you have to jump through with bank underwriting. And then the last thing with banks is they're going to often require a deposit relationship. Loans are very easy to make, especially for multifamily. It's easy to understand. There's a heavy demand for multifamily debt. What's hard to get is deposits, and so banks will typically mandate some kind of deposit relationship if you want to get a loan from them. That's not always the case, but most banks are very eager to grow their deposits, and so they're going to put that in their loan agreement as a covenant. If you don't maintain a $50,000 average deposit throughout the life of the loan, we're going to jack up your interest rate by 25 basis points, things like that. That is pretty much it with banks. Any questions before I move on to credit unions? Okay, great. Credit unions, they act like banks. They're typically going to want some kind of deposit relationship or membership. They are also focused on shorter term fixed rates. The primary difference with credit unions versus banks is credit unions offer complete prepayment flexibility. So there's no prepayment penalty with a credit union. You could close a loan today, pay it off 2 weeks from now, no penalty. The downside to credit unions is they typically limit their amortization to 25 years. There's a couple out there that are doing 30 years, but for the vast majority of them, they shorten their amortization to 25 years, which is going to put a crunch on all your return metrics, your cash on cash, your IRR, et cetera. But if you're looking for perm debt that has complete prepay flexibility, credit unions are typically going to be a good option. And then the last source of permanent debt I'm going to talk about is life company debt. They are pretty attractive at lower leverages. They always want to be under 65 LTV, sometimes less than that, and they can offer very attractive spreads at lower leverages. The problem with life companies is as soon as they fill their allocations for the year, they're out of the market. They're done, and that can happen in the second quarter of a year. They might just shut off the valve after June 30th if they did a bunch of deals in the first half of the year, and then they're out of the market until the next year when they get their new allocations. So that's just something to be aware of with life company lenders. The pros are, besides the pricing, there's no bank relationship requirement. And one thing they're really good for is ground up construction financing on larger deals. That's pretty much it for perm debt. The last topic I'm going to talk about is bridge debt. I'm not going to go into construction financing unless you guys want me to. Really, the most relevant types of debt for the deals you're looking at are going to be perm debt and bridge debt. Any questions before I move on to bridge debt? Okay. So bridge debt is primarily offered from debt funds and banks. Debt funds offer non-recourse bridge loans that are either going to be fixed rate or floating. There are much more floating rate bridge lenders out there than there are fixed rates. There's a few fixed rate lenders out there that want to be doing smaller loans, specifically $1 to $10 million. There's a couple that'll go up to 20 million. Interest rates on bridge right now on the fixed rate side are going to be like 7.5 to the high 9s. Just depends on the lender and what their appetite is for the asset, the sponsorship, and the business plan. Those loans are going to be shorter term in nature. We're talking 12 months to 36 months. They may structure in extension options at their discretion. They will make you pay for the extension option, and they will reprice you to wherever market rates are at that time if you exercise an extension option. But bottom line is shorter term loans. The benefit of bridge debt is you can get higher leverage than you can get with perm debt. Bridge lenders were doing up to 80% loan to cost, sometimes higher, sometimes even up to 85% loan to cost. Those LTVs and LTCs have come down quite a bit. Average leverage on a bridge loan today is probably 65, maybe you get to 70 for the right deal, but they've definitely backed off their leverages. But it's a great mechanism. If you're looking at a value add type of deal that requires a pretty significant amount of rehab, $10, $15, $20,000 a unit, and you want to finance that CapEx instead of raising equity for it, you can use a bridge loan to do that. So they'll typically do, in today's market environment, 65 to 70% of the total cost, which would be your acquisition price, plus your CapEx dollars. That's pretty much it for fixed rate bridge. Floating rate bridge lenders is almost an entirely different discussion just because there's so many of them out there. I mean, we're talking hundreds of floating rate bridge lenders, and they are highly complex, highly structured loans. The bottom line with floating rate bridge lenders, and it's basically in the name, is that the interest rate's floating on a monthly basis, and it's indexed. Most of it's indexed to term SOFR, which is like 4.35% right now. And a lot of these guys are doing 350 to 400 spreads over that. So you're well into the sevens, if not eights, on a floating rate bridge loan. Whereas I mentioned earlier, you could have been in like the low threes earlier this year on that type of debt. What I want everyone to understand is if you're looking at a floating rate bridge loan or even floating rate agency, you have to buy an interest rate cap. And interest rate caps have become very expensive. The cost of them has come down recently, but you know, they were as cheap as 25, 50 basis points of the loan amount earlier in the year. Now they can be upwards of 200, 300 basis points of the loan amount, which is a lot. When you're underwriting a deal and you have to factor in 2 to 3% of the loan balance for a rate cap, that can become significant when you're modeling your returns. And an interest rate cap is nothing more than an insurance policy that protects both the lender and you as the borrower in the case rates go over what's called a strike rate. And what we can do and what we have done for clients to lessen the upfront cost of an interest rate cap is we'll negotiate a higher strike rate for the client. Usually lenders are receptive to that. Or we'll negotiate a 2-year cap instead of a 3-year cap. If you can just buy a 2-year cap and maybe escrow for the cost of the 3rd-year cap up front, that's also going to lessen the upfront cost. So there's things we can do to negotiate with bridge lenders. The loan docs are negotiable. A lot of it is negotiating between the borrower and the lender. But yeah, they're very complex. There's a lot of post-closing reporting requirements, ongoing debt yield and debt coverage tests, and there are remedies they will invoke if you fail to meet one of those tests. And so if you guys are ever considering doing a floating rate bridge loan, talk to us. We'll counsel you guys correctly, and we'll negotiate terms for you that make the best sense. That's pretty much it for those 2 different types of financing. The last one is seller carries. Those are becoming more prevalent in the market. That's where the seller will just carry back, 65%, have the borrower come in with 35% down. They'll do a seller carry for, 3 years, 5 years, whatever the term is, at 5.5%, just using round numbers. And that's becoming more common in the market, just because there's an absence of leverage in the market with other permanent debt sources, and some sellers understand the asset, they understand the market, they're perfectly content just clipping coupons at 5.5%, 6% every month. That is pretty much my discussion on debt strategies. Happy to answer any questions, talk about the Fed, talk about the current state of the market, where I think the market's going, but I think I'll just go ahead and stop there. I want to be cognizant of time. I had no idea I was going to be talking for 45 minutes here, so I apologize if I went over, but that's pretty much it for me.
Oh, this was great. Thank you so much, Alex. And for the sake of time, there was a question about construction debt. So Chris, I'd encourage you to reach out to Alex. Alex is very open to educating and counseling and providing insight with other operators, and he could dive in a little bit deeper to that. Listen, I don't know if you all experience this as well, but debt and financing can be a very boring topic to talk about. But when you get the right person discussing it, such as Alex, you could tell he's very passionate about this and he knows what he's talking about. And the great thing is, and he's alluded to this and mentioned it multiple times, Alex doesn't work for a bank. He's a broker. So he's able to go out and shop and find you the best product for what it is that you're looking at. So, Alex, what's the best way that people can get a hold of you, contact you?
So alex.walton@cbre.com is my email address. I'm checking my emails constantly. My cell phone number is the best way to call me. It's 480-416-9177. Usually available for any kind of, multifamily discussions, debt, really anything pertaining to the Phoenix multifamily market or any multifamily market for that matter. We're not just doing deals in Phoenix, we do them nationwide. I'm happy to discuss. And the last thing I would say is we are brokers on everything except for agency. If we are looking at an agency loan, we have the license to originate those directly, whether it's conventional or small balance. CBRE Capital Markets is the lender of record. We're the ones that really make all the decisions, do the underwriting. It's a very streamlined process. If the deal does not fall into the agency bucket or it's not the best fit for your business plan for whatever reason, that's when we act as brokers and we'll go out and find the best capital source for the deal. So yeah, I encourage you guys to reach out to me directly. Happy to have further discussions about anything we talked about today or really anything else.
Excellent. Thank you so much, Alex. And we'll include his contact information in our follow-up email that goes out on Tuesday mornings, along with the recording of this webinar. So Alex, also happy to share it with you as well. If you want to chop it up and use it for any marketing for yourself, then
that'd be awesome. Yeah, that'd be great.
I'm happy to share that with you. Folks, appreciate you joining us for another Rev Real Estate Live, where we focus on educating you on becoming better and more sophisticated apartment investors. We will not be having a webinar next week because of the holidays. So keep an eye out for the emails, and 2 weeks from now, we'll be coming back talking about what a standard value add business plan is in the multifamily space. Alex, thank you so much for joining us. And folks, hope to see you on the next Real Estate Live. Thanks for coming out.
Thanks for having me. Happy holidays, everybody.